Welcome to the Norris Group Real Estate Podcast, a show committed to bringing you insights from thought leaders shaping the real estate industry. In each episode, we'll dive into conversations with industry experts and local insiders, all aimed at helping you thrive in an ever-changing real estate market, continuing the legacy that Bruce Norris created, sharing valuable knowledge, and empowering you on your real estate journey. Whether you're a seasoned pro or a newcomer, this is your go-to source for insider tips, market trends, and success strategies. Here's your host, Craig Evans.
All right. Hello, everyone. Thanks for joining us again. I am super excited. Today, we've got a special guest and a good friend of mine and a good friend of everybody and all of our listeners. So we have Bruce Norris with us again today. So Bruce, how are you? First of all, I guess I want to just say, I know we haven't had a chance to talk in a few weeks, but how are you? How's everything been going?
Good. Yeah, last time you and I exchanged texts, we were both dealing with bronchitis or something, you know?
Right.
So, yeah, I may go through this whole thing without coughing.
So you got your water and you're ready, right?
Well, I have my Coke Zero. That's close to water to me.
All right. Well, listen, so here we are. We're about 30 days away from our event on June 8th called Elevated. I am really excited to let everyone know what they're going to be able to expect. We'll, of course, have some old friends with us. Keystone CPA and UDirect IRA are both going to be there. Part of what I would like us to do going forward is to help investors be better, putting together resources and tools, helping them become better operators and investors. On June 8th, Bruce, we'll be talking about giving investors more tools for their tool belt. On the T&G side of things, I'm going to be giving a sort of a state of the union of the Norris Group at Elevated, what the Norris Group has been through the years, what we are now, and what my vision is for the future of the company that I'm now blessed to own. We got some great giveaways coming up at Elevated 2. We're going to be giving away 5 of our VIP subscriptions. We've got 2 tickets to I've Survived Real Estate that we're giving away, and then 1 lifetime VIP subscription. Keystone, I could not believe it. They're so gracious. They're actually giving away one of their strategic tax planning sessions for real estate investors, which is worth, they charge $49.95 for that. So that's not $49.99 to $50, $4,995. That was a huge gift from Keystone. Very excited for them to do that and for them to have that stage presence. UDirect is also, they have a very special giveaway that we'll announce this week as well. Joey's been getting a lot of feedback about the current market, though, and there's a lot of doubt and some fear out there that we wanted to jump on the show today and talk about some of those items that folks are worried about and what your presentation, Bruce, at Elevated will address. So, of course, people also want to hear and see what you think about for the rest of 2024 and beyond. So I said, Joey, then let's get Bruce in here and let's start having these conversations. So let's get to it. So what are the main factors that you see are contributing to the current state of real estate in California, Florida, and the country as a whole?
It's interesting. There's a lot of commonality in the sense that a lot of the people that participate are fearful. Of course, you have companies that create data. And it's interesting, Craig. It's sort of like what story do we want to tell? You know, if we're selling foreclosure lists and we have to say foreclosures are up 79% this year, and that could mean they went from 3 to 6 or something like that. It really helps to have your own idea of what matters. So that's the most important thing, is to kind of what the Norris Group has done over the years and what you're going to continue to do is allow the investor to make their own educated decisions. Because without that, you can get led astray. You and I both know there was an article put out, recently, and how bad things were and all that. Just for fun, I pulled up the latest information for the last year in Florida, because it was sort of directed to Cape Coral and part of Florida and that type of thing. Okay. So in my study, distressed sales have to be a very big percentage of a market for it to get destroyed. Okay. So California has had those cycles where they were a 25% participant and no price damage happened. 40%, some price damage, 70% price crash. So where we are right now in Florida for the entire year, we had 186 combined short sales and foreclosure REOs, that type of thing, against 23,000 sales. That's not even 1%. But it also makes it easy to say, oh my, so let's say that number went from 186 to 372. Okay, so you could write an article. Oh my God, the foreclosures have doubled, and they now represent less than 2% of the market, which historically is meaningless in devastation, zero. So, that's what's interesting about becoming self-taught on this particular subject. I don't know that there's a more important subject to know than knowing when to be afraid and when not to be. So what's for sale right now is either existing inventory or new inventory, 99%.
Correct.
So then you ask the question, so when's the last time we had a price crash with that being true? Never.
Right.
So that's important to know because, okay, now let's be devil's advocate for a second. Can you have inventory that's too much for a category? Okay, so let's say you have too much of a $700,000 house in an area that only moves 40 of those a year, and you have a builder that built too many. Well, that's a challenge. That's a very specific problem that's not market wide.
And it's interesting that you're talking about, you mentioned the data that came out from Redfin last week, and everybody's talking about that. And I went back through and they're talking about the amount of inventory that's on the market and how long things are sitting and all of that type of process, Yeah.
So that means they're completely unknowledgeable about something else. So I didn't mean to interrupt you, but let's go to, you want a lot of inventory. So whatever Florida's inventory is, let's go to California, 1980, 22 months of inventory, 22 months.
Right.
17% mortgage rates, 10% unemployment, price damage, 0. So that's a reality. So you look at that and go, how is that possible? It still drives me crazy. How is that possible? Well, when you start studying others, you go, that's not the important category. What's the important category is the participation of the have to sell inventory called REOs or short sales. Once they become a participant in a 25 or 40 or 70% number, historically you have a problem.
So here's the thing that's funny. We're very strategic and targeted in what we do, right?
Right.
So the product of what we've got is a little different, but when I started looking at the data, I said, okay, we've got to take this and something that you taught me years ago. Don't look at the data necessarily trying to prove something. Just look at what's true.
Right.
Right. So we looked at it and we said, okay, well, we had to look at, obviously, are we in a risk, right? Are we in a risk of being in a spot here? Because we got a lot of people that we're beholden to that we need to make sure we're never going to put equity in danger here. So we looked at all of our stuff. If I take, let's say, our largest model, we've got that 2013 model that we build, Bruce, if I take that and I pull all the inventory that's available in the markets that we build for, how many houses out of those thousands that Redfin talks about, and I'm putting you on the spot here, how many do you think are currently on the market in the size and price point that we deal with? How many do you think are on the market?
I'd say 48, 4 dozen.
11.
See, what's interesting too is when we decided to build a certain product type, the amenities were the most desirable and created the biggest spread. So we're pending right now on a house that's 725, that's 2170 square feet. And why is it pending for that? Because it has hurricane windows, it has an enclosed pool, it has the things that people wanted, and it's the kind of person that writes a check for it. But you're right, there's a lot of inventory, that doesn't have the hurricane windows or the enclosed pool, the amenities that people will pay large dollars for.
Well, and it's that, and part of what we've seen out of that is that a lot of what is sitting on the market is stuff that's priced incorrectly.
Sure.
Depending on the market. I mean, there's stuff that's
got
sitting
really happy. When prices went crazy, you just thought, well, let's ask $1 million and see what happens. You're talking about these price reductions. There's 40% of the inventory have price reductions. Yeah, off of a house that moved up 70% in 24 months.
So let's talk about interest rates. Let's look at interest rates from a historical process. How do you see that the interest rates have affected the rise and fall of the market?
Well, the interest rate reduction that was in place for about 2 years allowed for prices to go up in Florida and California an enormous amount and not increase the monthly payment very much, oddly enough. So what it really did, it had a long-term effect on how much it will be for sale for a long time. So Craig, think about having a 2-year period where interest rates, like you refied at 4.5 when one, I can't believe that. 3.5, I can't believe that. 2.75, oh my God. And in that journey, you said, you know what, we can put a pool in. It doesn't cost us anything a month, or add an office, or do both. Those people are not going anywhere. Even if they got transferred, I bet they keep that house because the interest rate is more important. So in typical markets, 85% of what's for sale is existing homes. A huge percentage of those are not going anywhere. So the devastating impact for a real estate industry is that you've cut the commissions in California by 50%. That's how much less is going to sell, because that inventory is camped out and not coming back. That means you rely on new inventory, which California doesn't build very much, or existing inventory that's owned free and clear, or whatever the circumstance is. So Florida's, it's got the same type of thing. It has a lot of people that had a chance to refi homes. They're not going anywhere. That inventory is not showing up. So what is showing up? Well, a lot of new builds, right? A lot of new builds come up, and the builders are, they're creative. They can say, okay, well, we can buy down interest rates and do other things. So I just don't see anything that bothers me long range. Like, oh my gosh, we're going to have a glut of. The only thing that matters is it a glut of have to sell inventory called short sales, REOs? If the answer is that is not dominating the market, then please show me in the last 50 years where we took a price hit of any significance. You've never have.
Well, so, all right, if we go back to interest rates, we've talked about historical values and what does that mean and what has it meant to us? What do you see for the future? I mean, there's a lot of talk. Are we going to have rate drops and things like that? There's a lot of talk even in the last week about the CPI and what people are suggesting is going to take place with the CPI due to the job market, things like that.
Let's assume we're going to have a bit of a rough patch where we have maybe negative GDP. So who gets off the sidelines? So let's say interest rates go, where are they about now? 7?
7 and 8 is a national number.
Okay. So let's say the 10-year T-bill goes down, and so you have a mortgage rate of 4.75. Who gets off the sideline? The buyer that's been waiting, or the seller that has a 2.6% mortgage? I think he's going to get outnumbered by the buyers that go, oh, this is my last chance. I mean, that's where I think common sense would land, is that there's more buyers on the sidelines waiting to get one more chance at something that starts with a number that hasn't existed in a long time. So I think it puts pressure on inventory, and I think prices get more firm than they go up. We used up almost all the upside for quite some time, unless you're in a completely euphoric mood to buy real estate. So you would really need the euphoric buyer to show up, meaning he has a chance at a 4.75, and he's going to get one. And
right. That's
the way his mindset is. That could happen, but it's a healthier market if it doesn't. It's better to just let the earnings grow to where that affordability number actually grows of natural causes and builds back up to some normal number. Because right now, all the numbers in California and Florida the math of it is you're at the highest number you've ever been, which you normally give that back. The only reason we're not giving it back is because so many people are going nowhere. The other big advantage for Florida was interesting about the article that Redfin did, was talking about like somehow people were now priced out of Florida. which I found really interesting because Florida's the median price, the same median price as it's a nation. California is twice the number of Florida. So think about if you owned a $400,000 house, which is, let's say, inventory that you would sell, right? 300,000 and 400,000 new houses.
Yep.
And they got a 3% mortgage on that. How is that, like half of rent?
Yes.
Yeah. Where are they going to go? They don't want to go. They're probably, and the other thing that did create was excess money. It was like you got a raise. Wow, your payment just went down by a whole bunch. $600 showed up a month that's going to get to do other things. I don't think people are ready to give that up. I just don't. So anyway, I think the pressure goes to the buyer side, not to the inventory side.
There's times where it can be a double-edged sword, right?
Sure. If you have more eager buyers than you have inventory, then you'll have price push, but as long as you have a legit lender environment, where people aren't getting stated income loans and lying on their application, it has a natural stopping point because you just can't get a yes.
Right.
Okay. So in 2005, that didn't happen. There was no yes. There was no no's. And that's why it went crazy. So we're really not facing that at all. But we have used up the upside, and we used it up really quick. But we had a payment that resulted in a very reasonable payment for the ownership and the equity position too. So you're talking about, okay, you've got a mortgage that's under 3 a lot of times, and you have a payment that's less than rent. That's a very stable household.
Right.
So, what happens if you have to sell? Something happened. Well, you've got a huge amount of equity. You're not going to lose that house to a trustee sale, a foreclosure sale. And if it did go to foreclosure sale, it would be bought by you. It wouldn't compete in the listings. It would be bought at the sale.
Right.
It's so much equity. So that's the difference. See, when trustee sales were going on in 2008, and this is in California, they had $350,000 loans on it, and we would win a bid at $80,000. So the environment is so different.
One of the things that we've been seeing in the last, because you and I have been talking over the last several months about what the market in Southwest Florida really looks like and what's actually happening and how many sales are actually happening, how many pendings are actually happening, and what real is on that. And in that process, one of the things that we've been seeing in certain price points, again, what has been slowing down, so to speak, the sales aspect is not the price. Interestingly, it's been that they can't afford the monthly payment.
Right.
They can afford the price. They can't afford the monthly payment due to the interest side of it.
Right.
So it's interesting as you keep talking about, that once that shifts, not only are people that are in, let's say, a $400,000 or $500,000 house, or 350, a 6, whatever it is, if they've got that 2 or 3 or something with a 4 in front of it, I agree. I don't think that people are that's not going to be the people that are now entering the market again.
No,
it's going to be the people that have been forever saying, I can afford the price. I can't afford the monthly payment because of that 7% rate.
Yeah. You got a lot of people that are still migrating to Florida, and it's the right people. The other thing that article talked about is, people aren't going to Florida anymore. They're going to, wherever else they're going to. That is completely incorrect. And the people that are coming to Florida are bringing outrageous wealth. That one chart that shows Florida's number 1 and more wealth transfer than number 2 through 10.
Correct.
So, I'm sorry, but that's why when I read some of that, I said, let's debate Redfin. That would be so much fun. Anyway,
you've talked about migration some, but how do you believe the migration helps, or I shouldn't say helps? How do you believe it impacts the health of the real estate market?
I do think it's a driving force. You have a lot of times you have people coming from more expensive states, so they're getting rid of a mortgage. So you go, let's say a lot of people come from New York, right?
Right.
And, okay, well, it's really easy to see that you could buy a Cape Coral $800,000 house would be a lot cooler than maybe your 1.6 million house in New York that you owed 800 grand on. So you sell that, you own this free and clear. What does that do? That makes a person have no payment, and they're ready to go out to eat. So migration is very healthy for the Florida market because of the wealth transfer. You're bringing a lot of money here, and people, I think, have gotten rid of their payments many times, and they're ready to go have some fun or buy a boat. I think it drives the Florida economy. I absolutely do. It's the right migration.
What do you think the long-term outlook is on migration in those areas?
I think Florida and Texas are the winners going forward for maybe 10 to 20 years. In other words, it's a new California, and California is not going to get that back. They've gone through their cycle. I mean, in the 70s, they were rocking and rolling with all of that. And no, it's just, and the big advantage for Florida is that your property tax isn't 3% of the value of the property. That's a big bill in Texas, right? So, when prices go up, and it's a variable. So California has one thing, you do have a fixed tax bill on your property. If you bought it 30 years ago, your tax bill is way less than your neighbor that bought it last week. But in Florida and Texas, that changes on every couple year basis. But it's still a reasonable number in Florida. It's not necessarily a reasonable number in Texas.
Do you see the Fed making a move this year?
I do. Probably more than one down. And how aggressive? I don't think they want to repeat the scenario that we had in 2019 and 2020, 2021. I don't think they want to have that recycled. But I think they are going to pay attention to trying to prevent a deep recession. So you have, it'll be interesting, the categories that seem to be going the wrong way are full-time jobs. So you have a lot of part-time jobs, but you don't have a lot of full-time jobs.
Right.
And so you're starting to have holes in that end of the data, if you would. So, I think you're going to have interest rate reductions, and I think they may be very gradual and over a longer period of time, unless something really crazy happens again.
And the job market is such an interesting thing, because when you look at how many places are still begging for people to work.
Yeah. Well, one of the interesting factors is you have, I don't know the number. I remember looking at it, and it was just astonishing how many young adults are literally not even in the workforce. They're just, okay, you're not even counted anymore because you don't intend to get a job. I'm right. Yeah, you're going, holy cow. Florida is a magnet for jobs. And
absolutely.
Right. Well, that's what causes migration, opportunity. So that's why the long-term picture for Florida to me is very positive. And it has a starting point of a median price of the country. And again, a lot of your wealth gains and migration gains come from places that are much more expensive, where people can hit the reset button on their entire life, sell something that's twice as expensive and own something free and clear and get rid of their $5,000 or $6,000 a month payment. That's crazy. That doesn't have, you don't have that opportunity in California. I'm not sure where you'd sell, maybe the island of Hawaii or something, but there's very few places you can sell something and go to California and say, oh, wow, that's a deal right there.
Well, hey, let's jump back real quick on some of the Fed stuff. I know, the Feds they keep pressing, and they're looking at, we don't want to make cuts until inflation is clearly on its way to being at 2. And what do you see from an inflationary perspective? Do you see that? Do you see it sustaining where it's at? Do you think it's going to have to get worse before it gets better? What do you see out of that?
As far as the inflation number?
Correct.
No, I think we're on the brink of having that soften and go the other way. And, I think part of it is, California has laws now. Let's say, for instance, this is just California, but you have to pay somebody that works at McDonald's or something $20, right? So
Yep.
there's so many of those that are just closing, saying, "See you later." So, in trying to be the most fair, you could be starting to create an awful lot of unemployment because it just doesn't make sense. When you have a couple of people get a hamburger and it's $25 when you leave the window, I think that's going to cause a fair amount of unemployment and closing of commercial properties too. So I do think we're in for maybe a slow round of declining GDP growth and then a very gradual Fed, unless the Fed gets concerned about something much worse.
So we've talked through a lot today. I've picked your brain on a lot. We don't want to give the farm away because we really want people to be at the June 8th at Elevated. I'm excited for hosting that and to get up there and start talking about what all we've got and what's coming. And I'm excited for you to be able to give some of the points that I know you and I've been kicking around. But in the short term of it, is there anything that you think, hey, Craig, I really wish you would have brought this up today because I wanted to tag on this. Is there anything that I didn't mention today that you're keeping an eye on that you wish I'd have brought up?
Not really, but one thing I would want to point out that what you said is that it's so important that our process doesn't begin with the conclusion that we want. That is the last thing that we consider. So go through all of those statistics, even like the week before that event, I'll be looking at all that stuff like I never looked at it before. So I could say, okay, this is the most logical outcome. And then we can go backwards and relate to the other outcomes. So it's not like, this is what I want to happen. I sell data and it would be really neat if we had a bunch of foreclosures. So therefore, we're going to say this, and boy, that's done a lot. It's so sad. But the president of Ca in 2006 wrote a book, and it had a house that was elevated in the sky. And his prediction was this is not going to end. It's going to go for another decade. And it was so sad because that was the agenda despite the data. And it was just a terrible outcome for somebody that is an economic, has a PhD in economics and came out with a conclusion. And the other thing that doesn't do, and see, this is what we want to do at our June event, is have our investors understand what's likely next so they can put themselves in the right position. What that guy did that day, and I don't think he intentionally did it wrong. I think that was what he believed. But who was ready to be an REO agent if they were listening to him? Nobody. Nobody called the lender up and said, who was the number one REO agent in Riverside? A guy that took our seminar in 2006 called the California Crash. He at times had over 1,000 REO listings.
Wow.
Yes. Because he called the lenders in advance when they had no REOs. You're going to get a lot of REOs. Here's my name.
Yep.
Yeah. So that's what June's about, taking a look at what's next for real. One of the things that the education system that's inside of the Norris Group's website does, it takes a look at charts and says, what's the most appropriate action for an investor tomorrow? And there's, over 20 different buying systems. A lot of you don't touch for years because it's not the best thing to do. So why not do the next best thing? Because you've got people, well-meaning people teaching in Florida. I just read the invitation, Florida foreclosure opportunity. So he's teaching a foreclosure seminar in Florida, and I'm just thinking, it sounds so, the verbiage sounds so good, and yet you're going to fight over all four of them. It's like, oh my gosh.
Well, I guess the last thing I would want to say, because again, I am excited to see you and be with you in June and to start going over, what is the market going to look like? But is there the one thing that makes you optimistic about the market? What's the one thing that you would look to right now from an optimistic viewpoint of the market?
Well, most of the people are going to be attending in California are in California. So the inventory, I just looked at it today, keeps on declining in, days on market. So that's a guarantee for price support, if not price increase. So California market's not going anywhere because it doesn't have REOs and it doesn't have builder oversupply. It has existing inventory that's showing up half as often, and it has demand that keeps on coming. So when you get an interest rate that goes from a 7 to a 5, you're going to have more people come off the sidelines. So you probably will have yourself a pretty healthy market price support wise and keep the gains in place, which is to me more important than worrying about new ones. You already got a lot, it'd be nice to keep.
Yep. Well, Bruce, man, I can't thank you enough for coming on with me today. I always look forward to just getting to see you as my friend. But also I know our listeners love when you get to come on and you get to share your thoughts and your insight. For all those listening, thank you so much for being with us today. We can't wait to see you in June 8th at our event. And Bruce will be there sharing his insights and giving several points about what the market's looking like this year. I know it's not a full timing seminar, but we've got some good stuff that we're going to be doing. So again, thank you so much for being with us today. We'll look forward to seeing you next week. Thanks so much.
Okay, great.
Have a good day.
Bye-bye.
Thanks, Bruce.
For more information on hard money loans, trust deed investing, and upcoming events with the Norris Group, check out thenorrisgroup.com. For more information on passive investing through the DBL Capital Real Estate Investment Fund, please visit dblcapital.com.
The Norris Group originates and services loans in California and Florida under the California DRE license 01219911, Florida Mortgage Lender license 1577, and NMLS license 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the hard money tab.